This is a breaking development in the artificial intelligence sector that could reshape the entire technology landscape. Bank of America has issued a stark warning. OpenAI, the company behind ChatGPT, is becoming a critical problem for the world's largest tech corporations, and the implications are staggering. What we're seeing right now is a fundamental paradox at the heart of the AI boom. The same tech giants rushing to sign billion-dollar deals with OpenAI are simultaneously locked in direct competition with the very company they're funding. This isn't just corporate drama. This is a trillion-dollar risk that could determine winners and losers in the AI race. Let's break down exactly what's happening and why analysts are calling this a two-sided strategic nightmare. Bank of America analyst Justin Post has identified what he calls a critical competitive threat facing mega-cap technology companies. Here's the situation. Microsoft, Google, Amazon, Web Services, and Oracle have all signed massive infrastructure deals with OpenAI. They're providing the computing power, the data centers, the cloud capabilities that OpenAI needs to train and run its AI models. But here's where it gets complicated. While these tech giants are enabling OpenAI's growth, they're also building their own AI products that compete directly with ChatGPT and OpenAI's other offerings. Microsoft has Copilot. Google has Gemini. Amazon is developing its own AI services. They're all in the same race, yet they're simultaneously each other's customers and competitors. Post puts it bluntly, the strategic risk is two-sided. If OpenAI succeeds in its ambitious expansion plans, it becomes an even bigger competitive threat to these companies. But if OpenAI fails to meet its internal targets, it could underutilize the computing capacity it has contracted, leading to overcapacity in the cloud industry and declining revenues for the hyperscalers. This is not a theoretical concern. OpenAI's spending commitments have already exceeded $1 trillion between now and 2035. That's trillion, with a T. The company has inked deals with Broadcom, Oracle, Microsoft, NVIDIA, AMD, Amazon AWS, and CoreWeave. These are among the largest technology contracts ever signed. Let's talk numbers because they're genuinely staggering. OpenAI is targeting $41 billion in new product revenue by 2030. That projection likely includes advertising revenue and e-commerce commissions, markets currently dominated by companies like Meta and YouTube. To put that in perspective, Bank of America estimates that $41 billion would represent approximately 8% of the entire advertising and e-commerce commission industry by 2030. We're talking about OpenAI potentially capturing a massive slice of digital advertising spending, directly threatening the core business models of Meta Platforms and Alphabet's YouTube. But here's the catch that has financial analysts concerned. OpenAI is committing far more capital than it's projected to generate in revenue. The company is essentially spending money it doesn't have yet on infrastructure that hasn't been built for customers it hasn't secured. This creates what Bank of America describes as a net competitive threat to big tech internet companies. The competitive risks across search, e-commerce, and enterprise AI are outweighing the modest cloud revenue these companies are earning from their OpenAI partnerships. Now let's examine the broader financial picture, because this is where things get truly alarming for the entire AI sector. Bank of America has issued another warning. The AI boom is hitting a cash crunch. Tech giants are increasingly turning to debt to finance their artificial intelligence ambitions, and the scale of borrowing is unprecedented. In just September and October of this year, companies like Meta Platforms and Oracle issued over $75 billion in bonds and loans to fund AI data center construction. $75 billion in 2 months. That's not sustainable growth, that's a spending frenzy. Let's look at specific companies. Oracle now carries nearly $96 billion in debt following an $18 billion bond issuance and a $38 billion loan. With quarterly net income around $3 billion, rising interest rates could consume an enormous portion of their profits. As one analysis put it, Oracle is essentially spending money it doesn't have on facilities that haven't been built for customers it doesn't have. The broader trend is even more concerning. Consensus estimates show AI capital expenditures hitting 94% of operating cash flow minus dividends and share buybacks in 2025 and 2026. That's up from 76% in 2024. These companies are maxing out their ability to self-fund AI investments. This brings us to the question everyone in the financial markets is asking, are we looking at an AI bubble? The latest Bank of America Global Fund Manager survey reveals something that hasn't happened in 20 years. A net 20% of investors managing $550 billion in assets now believe companies are overinvesting in AI infrastructure. This is the first time since August 2005 that fund managers have signaled that corporate spending has gone too far. Think about that timing. 2005 was just before the housing bubble burst and the global financial crisis. Now, fund managers are seeing similar warning signs in the AI sector. Michael Burry, yes, the same Michael Burry who predicted the 2008 financial crash and was featured in The Big Short, has been making cryptic posts about what he calls the AI money machine. He's shared diagrams showing how NVIDIA, OpenAI, Meta, Oracle, Microsoft, and other tech companies are essentially paying each other in a circular financing loop, and he's betting against NVIDIA and Palantir, two of the biggest names in AI. Following Burry's public skepticism, the Nasdaq suffered its worst week since April, with AI-linked stocks tanking. Investors are being forced to confront a fundamental question: what's the gap between AI spending and actual returns? Let's examine what this means for specific companies, because the competitive dynamics are shifting rapidly. Microsoft is in perhaps the most complicated position. The company has invested billions in OpenAI through a multi-billion-dollar partnership announced in 2023. Microsoft's Azure cloud platform has been crucial to OpenAI's growth. But now, OpenAI is restructuring to become a for-profit entity, which gives it more freedom to pursue independent funding and potentially reduce its reliance on Microsoft. Meanwhile, Google is pouring $40 billion into Texas data centers as part of its own AI infrastructure push. The company is racing to make its Gemini AI competitive with ChatGPT, while simultaneously providing cloud computing services to OpenAI through some contracts. Amazon Web Services is in a similar bind. The company just struck a major compute deal with OpenAI, but it's also developing its own AI services and competing for the same enterprise customers that OpenAI is targeting. Oracle's situation may be the most precarious. The company has taken on massive debt to build AI infrastructure for OpenAI and other clients, but if demand doesn't materialize as projected, Oracle could be left with expensive, underutilized data centers and crushing interest payments. Here's an angle that hasn't gotten enough attention. OpenAI's expansion into advertising could devastate companies like Meta Platforms and YouTube. Right now, Meta and Alphabet dominate digital advertising. But Bank of America believes OpenAI will soon begin competing directly for marketing and advertising budgets. If ChatGPT becomes a primary interface for how people search for information and make purchases, advertisers will follow. Imagine a scenario where instead of searching Google or scrolling through Instagram, users are getting product recommendations and information through conversational AI. That fundamentally disrupts the advertising-supported internet as we know it. OpenAI is reportedly developing what they call agentic transaction platforms, AI systems that can complete tasks and make purchases on behalf of users. If that technology matures, it could capture a significant share of e-commerce commissions that currently go to platforms like Amazon, Google Shopping, and social media marketplaces. The competition isn't just about consumer products. The enterprise market, selling AI tools to businesses, is becoming a critical battleground. OpenAI has already attracted over 1 million business customers. Anthropic, another AI startup, has over 300,000. These companies are moving fast and capturing market share from traditional software and infrastructure providers. Publicly traded tech companies are feeling the pressure. They're being forced to massively increase their AI investments just to keep pace. Google is spending $92 billion on capital expenditures, which Bank of America describes as a defensive move to prevent customers from defecting to ChatGPT, Perplexity, or other AI-powered search engines. Microsoft is in a similar position with its enterprise software business. Companies that once relied on Microsoft Office and other productivity tools are now considering AI-native alternatives. Microsoft's response has been to integrate AI deeply into its products and services, but that requires enormous ongoing investment. Let's talk about the practical constraints that could limit this AI spending boom. Bank of America analysts note that while OpenAI's plans are extraordinarily ambitious, the actual spending will be limited by real-world factors: access to electrical power and available data center space. Building a massive AI data center isn't just about having money. You need enormous amounts of electricity. We're talking hundreds of megawatts per facility. You need cooling systems capable of handling the heat generated by tens of thousands of processors running continuously. You need physical space, construction permits, and infrastructure connections. Many regions simply don't have the electrical grid capacity to support these facilities. Power utilities are racing to build out capacity, but that takes years. This creates a bottleneck that could slow the AI boom regardless of how much money companies are willing to spend. There's also the chip supply issue. NVIDIA has dominated the AI chip market, but supply has been constrained. Even with competitors like AMD increasing production, there aren't enough high-end AI processors to meet projected demand. This creates dependencies that expose companies to supply chain vulnerabilities. Now let's address the elephant in the room: stock valuations. Many AI-focused tech companies are trading at 40 times earnings or more. These valuations assume near-perfect execution of their AI strategies. Any stumble, slower adoption, technological hurdles, or the debt burdens we discussed earlier could trigger sharp market corrections. Fund managers are running extremely low cash levels right now at just 3.7%. Historically, when cash levels drop below 4%, it functions as a sell signal for global equities. This has happened 20 times since 2002, and every single time, stocks subsequently fell within the following 1 to 3 months. Bank of America warns that market froth, speculative excess, may need to correct further, particularly if the Federal Reserve doesn't cut interest rates in December. Higher interest rates make those massive debt loads even more expensive to service. Yet paradoxically, 53% of surveyed investors believe AI is already increasing productivity. There's long-term optimism about AI's potential, even as short-term concerns about overinvestment and financing grow. One factor that could dramatically change this entire equation: government regulation. As OpenAI shifts to a for-profit corporate structure, it will face increased regulatory scrutiny. The company currently has Microsoft holding a 27% stake, but that relationship and OpenAI's overall governance structure could attract attention from competition regulators. If OpenAI becomes too dominant in AI services, antitrust authorities in the United States, Europe, and other jurisdictions might intervene. That could limit the company's ability to expand into new markets like advertising and e-commerce. There are also growing concerns about AI safety, data privacy, and the societal impacts of artificial intelligence. New regulations could impose costs and constraints that make some AI business models less viable. The regulatory environment remains highly uncertain, which adds another layer of risk to the massive bets that tech companies are making on AI infrastructure and services. So where does this leave us? We're witnessing one of the largest capital deployment cycles in technology history. Over $1 trillion in commitments, $75 billion in debt issued in just 2 months. Companies maxing out their cash flows to fund AI ambitions. Bank of America's core warning is clear. OpenAI represents a fundamental competitive threat to the world's largest technology companies. These firms are caught in a paradox of their own making. They're enabling a competitor while trying to compete with it. Don't forget to subscribe.